Hi there. In this video, we explain how much you can gift tax-free in the UK and how HMRC rules apply for the 2026 tax year.
You work your whole life to build your wealth, assuming you can just hand it down to your children. But in 2026, simply wiring cash to your kids can accidentally trigger a 40% tax charge from HMRC. Navigating this aggressive new regulatory environment requires precision. That is where my tax accountant steps in, to map out a safe passage through the tax code. The pressure on families is increasing. The government has frozen the standard tax-free allowance at £325,000 and placed a new £2.5 million cap on business reliefs, squeezing UK entrepreneurs from both sides. Take Arthur. He's a 68-year-old business owner whose total estate is valued right at that £2.5 million mark. He wants to help his daughter with a house deposit, pay for his grandchildren's school fees, and start transferring shares of his business to the next generation. If Arthur acts purely on his natural generosity without a strict legal strategy, hundreds of thousands of pounds of his family's money will go straight to the government. Unfortunately, Arthur cannot just transfer unlimited sums of cash. HMRC requires him to first use his specific fixed annual gifting allowances. Every UK resident gets a £3,000 annual exemption. Unused 2025 allowances roll forward, stacking on 2026 to create a £6,000 tax-free safe zone. Plus, parents can give a child £5,000 tax-free for a wedding, layering another specific allowance on top. For his grandchildren, Arthur can also use the small gift allowance, giving up to £250 per person, provided he hasn't used any other exemptions on them. Stacking these allowances together creates a clean, unquestioned tax shelter. But for transferring real generational wealth, £11,000 barely scratches the surface. To move larger sums, my tax accountant implements a rule found in Section 21 of the Inheritance Tax Act, known as normal expenditure out of income. This allows for totally unlimited, immediately tax-free gifts, as long as the money comes from the giver's regular income, like pension payouts or dividends, and not their accumulated capital, like a savings account. Arthur receives healthy business dividends, leaving him with £30,000 of surplus income every year. He routes that exact surplus directly into his grandchildren's school fees. HMRC heavily scrutinizes this exemption. You must prove three things. They form a habitual pattern, they come exclusively from income, and they don't lower living standards. To pass that scrutiny, you must leave a perfect paper trail. This is the HMRC IHT 403 form. Schedule 2 requires a rigorous year-by-year expenditure log, tracking all income against outgoings. By systematically documenting and converting taxable assets into a stream of regular surplus income, you bypass the inheritance tax net entirely. Arthur still wants to give his daughter a £150,000 lump sum for her house deposit. Lump sums like this are classified as potentially exempt transfers. The rule is absolute. The gift only becomes completely tax-free if Arthur survives for 7 full years after making the transfer. This graph shows taper relief. Between years 3 and 7, the 40% tax rate steps down incrementally to 0. But there's a trap. This relief only kicks in if Arthur's total lifetime gifting has already surpassed his £325,000 allowance threshold. Because of the incoming £2.5 million cap on business reliefs, Arthur also needs to transfer his company shares immediately to lock in the current rules. Making these large lump sum transfers is a calculated race against the clock. If you sequence these gifts out of order, you can easily erase your entire tax-free allowance by accident. By executing this layered strategy, Arthur's first year is highly effective. Between the rolled over allowances, the wedding gift, surplus income, and the house deposit, he successfully transfers £191,000 out of his estate. This diagram shows the exact financial stakes. Doing this without a structured plan leaves Arthur's family exposed to a £76,400 liability. Proper structuring drops that tax bill to 0. He relied on 3 strict pillars: exhausting the annual exemptions, meticulously logging Section 21 surplus income, and starting the clock on the 7-year timeline. These tax rules are highly complex, completely dependent on your specific financial facts, and always subject to legislative changes. To build a bespoke, tax-efficient strategy tailored to your exact situation, contact the team at My Tax Accountant via phone or email today. Mastering the 2026 Inheritance Tax Code removes the guesswork. It turns wealth transfer into a mathematically precise defense of your family's legacy.